We now come to section 3.3, where we will look at an illustration of translation methods, and this will be through an example presented in the curriculum. This is an embedded example. It's not one of the blue box or gray box examples. Interco is a European company, so our parent company is based in Europe. The presentation currency is the euro. This parent company establishes a subsidiary in Canada. The foreign currency is the Canadian dollar. There is a question as to whether the current rate method should be used or the temporal method should be used. And in this example, we are going to use both methods and look at how using different translation methods can result in substantially different numbers on the income statement and balance sheet. When the subsidiary is established, this is what the balance sheet looks like. And note that here the numbers are presented in Canadian dollars. This is the foreign currency. The first question for you is, what is the balance sheet exposure? If we use the current rate method and translate all the assets from Canadian dollars to euro and translate the liabilities from Canadian dollars to euro, then note that the exposed assets, which is essentially all the assets, exceed the exposed liabilities. So with the current rate method, we would have a net asset exposure. On the other hand, if we use the temporal method, then we would translate cash, which is our only monetary asset, and our liability, which is also monetary. So note that in this scenario, we have a net liability exposure. Then we are given this particular income statement for the year of operation, and the numbers are shown in Canadian dollars. Our job will be to translate the income statement numbers and the balance sheet numbers into the parent's presentation currency. Over the year, this is what happens to exchange rates. First thing I want you to note is that the foreign currency or the Canadian dollar is the base currency. This is appreciating. So on 1st January, the exchange rate is 0.7, and over the year it goes up to 0.8. So the foreign currency is strengthening. Also note that we have been given the average rate. This is going to be used on the income statement. We are also given the weighted average rate when the inventory was acquired, the rate when dividends are declared, and then the rate at the end of the year. When we translate at the end of the year, this will be considered the current rate on that date. Here is what the income statement looks like using the current rate method. This is our foreign currency. On the left, we are translating using the current rate method. Note that with the income statement, we are translating all items using the average rate, 0.75A. A stands for the average rate. The dividend is translated at the rate which was in effect when the dividends were declared. Also note that, as we discussed earlier, the translation gain loss does not flow through the income statement when we use the current rate method. This goes straight to equity. On the right, we have the temporal method, where sales are translated at the average rate. Cost of goods sold, we use the historical rate of 0.74, which is given. Selling expenses are at 0.75 average rate. Depreciation is translated at historical rate. Interest expense and income tax expense at the average rate. So we come up with this number. There is a small difference in the income before translation gains and losses, and that small difference can be attributed to using a different rate for the non-monetary expenses, inventory and depreciation. Then these particular items, they need to be arrived at after we study the balance sheet. With the temporal method, the balance sheet needs to be translated first because we need to look at the revised value of the monetary assets and liabilities. By revised, I mean the value based on the current exchange rate. Based on that, we will come up with a value for retained earnings, and then we can work backwards to figure out the number for the translation gain or loss. As you can see, we have a translation loss over here. The amount of the loss will obviously be determined once we look at the balance sheet, but you should be able to figure out without looking at the balance sheet that there will be a loss as opposed to a translation gain. And why do I say that? If you recall, when we use the temporal method, we are only translating monetary assets and monetary liabilities. And based on the balance sheet, we know that the monetary liabilities are greater than the monetary assets. So we have a net liability exposure. We also know that the foreign currency strengthened. So the Canadian dollar went up in value. If the Canadian dollar or the foreign currency goes up and we have a net liability exposure, then that is a negative because this means more of an exposure. Higher exchange rate. More of an exposure means that there is a translation loss, and that's why we have a negative over here. Now we come to the balance sheet. The current rate method is straightforward. All assets translated at the current rate, all liabilities translated at the current rate. The equity is translated at the historical rate. The temporal method is a little more complicated. Monetary assets translated at the current rate, inventory translated at the historical rate which was given, non-monetary assets translated at the historical rate, monetary liabilities translated at the current rate, capital stock or equity translated at the historical rate, and then we need this number to balance. In other words, we do have this number for total assets. We also know the value of our liabilities. So assets minus liabilities will give us equity. Part of the equity is already explained using the historical rate, and the amount that is not explained then is simply a plug. So this must be the value for retained earnings in order for assets to be equal to liabilities plus equity. This plug for retained earnings is then taken to the previous slide where we can then compute the translation loss. This is Exhibit 5 in the curriculum. It actually is shown a little later, but I think this is a good place to discuss the material shown over here. And I'd say that from an exam perspective, understanding this exhibit is essential. We know that our parent's presentation currency is the euro, the foreign currency is the Canadian dollar, and in our example, the foreign currency has strengthened. So that means that this is the scenario we are dealing with. Also, when we use the temporal method, then we have a net liability exposure. So in the temporal method context, this is what we just dealt with in our example. Notice that with the foreign currency going up, that has a positive impact on revenue, a positive impact on assets, a positive impact on liabilities. However, since the liability exposure is more than the asset exposure, the impact on net income is negative and the impact on shareholder equity is negative. and therefore there is a translation loss. If there was another scenario where there was a net asset exposure, then all the numbers would be positive and there would be a translation gain. With the current rate method, all assets and all liabilities are being translated. So given that all assets or the value of total assets exceeds the value of total liabilities, we have a net asset exposure under the current rate method. So all these numbers are going up. The revenue is higher because the exchange rate went up, assets higher, liabilities higher, net income higher, shareholder equity higher, and the translation adjustment would be positive. This translation adjustment, however, shows up as equity, or it shows up directly in the equity part of the balance sheet. Whereas with the temporal method, the translation loss or gain shows up in the income statement. What if we had another scenario where the foreign currency weakened? Then with the weakening foreign currency, the revenue would be down, assets down, liabilities down, but these two numbers are up, and that is because in this column we are assuming a net liability exposure. So hopefully this does not surprise you. The scenario here is exactly the opposite of the scenario in the top left segment. Again, I'll emphasize that you need to know this exhibit very well. If you have time, then go over example 5 and example 6. Example 5 deals with the impact of different balance sheet exposures under the temporal method, and example 6 deals with the effect of direction of change in exchange rate on the translated amounts. Section 3.4 deals with translation analytical issues. We continue with the same example and demonstrate the fact that depending on the translation method used, the net income can be quite different. The asset and liability values are also different depending on the translation method. The net income with the current rate method is 885,000. With the temporal method, it is much lower because we show the translation loss as part of the income statement when we use the temporal method. That explains why this number is substantially lower than the net income arrived at using the current rate method. However, if the translation impact is removed and we look at income before the translation gain or loss, then the temporal method actually gives a higher income. Now, what does this mean for you as an analyst? Clearly, if two companies are similar and use a different method to translate, then you have to make adjustments. From an exam perspective, you are quite likely to get a question that compares the impact of using the current rate method versus the temporal method. You are also likely to understand the impact on ratios. In our example, the foreign currency strengthened. So what is the impact on the current ratio? The current ratio is current assets over liabilities. The first column simply gives numbers in Canadian dollars, and then these two columns, the second column gives the ratios assuming the current rate method, and this column gives the ratios assuming the temporal method. Why is this ratio, the current ratio using the current rate method, greater than the current ratio using the temporal method? Current ratio is current assets over liabilities. With the current rate method, all the current assets are being translated using the higher rate. Whereas in the temporal method, only the monetary assets are being translated. Inventory is not considered monetary. The liability numbers are the same in both cases, and that is why the current rate gives us a better ratio. What about the total debt over total assets? The debt numbers are the same, but our assets will be higher using the current rate because all assets are being translated. You can also now work through the rest of the numbers. You need to recognize whether the foreign currency is going up or going down in your exam question, and then decide which method will give a better ratio. A point to emphasize here is that the net income with the temporal method is low, but the operating profit with the temporal method is high because the translation loss is not included in the operating profit. In any case, go through these ratios and make sure you understand where they are coming from. And here are some more ratios. Next we come to section 3.5, translation when a foreign subsidiary operates in a hyperinflationary environment. The curriculum uses hyperinflationary and highly inflationary interchangeably. The learning objective uses the term hyperinflationary. So you need to know what US GAAP says in this scenario and what IFRS says. US GAAP is straightforward. US GAAP simply require use of the temporal method. On the other hand, IFRS require financial statements to be first restated for inflation, and then inflation adjusted financial statements need to be translated at the current exchange rate. Specifically, here is the process under IFRS. Monetary assets and liabilities are not restated. Obviously, these are already at fair value, so they can simply be translated at the current exchange rate. The non-monetary assets and liabilities need to be adjusted for inflation. They need to be restated, and restated costs are determined by applying the change in general price index to the historical costs. At times, the assets and liabilities might have been revalued. If items are carried at revalued amounts, then these are restated from the date of revaluation. All components of shareholders' equity are restated by applying the change in general price index from the beginning of the period or from the date of contribution to the balance sheet. All income statement items are restated by applying the change in the general price index from the dates when the items were originally recorded. Now this procedure is carried out in example 4 that I mentioned earlier, and specifically in the third approach or the third alternative used in example 4. If you recall, with example 4, we talked about the current rate method, the temporal method, and then the third approach essentially was using this strategy. Also, I want you to go through example 7, and we will make a separate video available that describes at least the IFRS treatment in example 7 in detail. One other important point to note: purchasing power gains and losses that arise from holding monetary assets and monetary liabilities need to be included in net income. And remember, this is the net income of the parent company. When we translate the numbers from the subsidiaries' financial statements to the parent's consolidated financial reports, then there will be an item in the income statement called purchasing power gain or purchasing power loss. And just to understand the context, let's say that our subsidiary has a lot of net monetary assets. Simplistically, let's say that this is just cash. Clearly, if there is high inflation here in the subsidiary country, then we being the parent are losing purchasing power. So there is a purchasing power loss, and that needs to be reflected in the income statement of the parent. On the other hand, if there is a net monetary liability, then there will be a purchasing power gain which will be reflected in the parent's income statement. Section 3.6, companies use both translation methods at the same time. And I want you to read this. This is an excerpt from the curriculum, but the core point is this: you can have a parent company with multiple subsidiaries. With one subsidiary, the temporal method makes sense. With the other subsidiary, the current rate method makes sense. And it is perfectly acceptable. And in fact, companies do use both methods. So that means that you will see translation gains and losses in the income statement, as well as translation adjustments in the equity part of the balance sheet. Section 3.7, disclosures related to translation methods. Both IFRS and US GAAP require two types of disclosures related to foreign currency translation: the amount of exchange differences recorded in net income, and number two, the amount of cumulative translation adjustment classified in a separate component of equity, along with a reconciliation of the amount of cumulative translation adjustment at the beginning and end of the period. We've talked about this, and this is fairly self-explanatory. There are a few other smaller minor items related to US GAAP which you can see in the curriculum, but at the very least I want you to remember these points. Then if you have time, go over examples 8 and 9. Section 4, multinational operations and a company's effective tax rate. This section and section 5 have been introduced for the first time in 2014. The point here is straightforward. When you have a parent company with operations in different countries, so let's say parent company and it has an operation in country X, country Y, the parent company operates in a country, let's say, with a relatively high tax rate, and it has operations in country X, country Y. Say the tax rate is relatively low in these other countries. Clearly, having multinational operations in countries that have different tax rates will impact the effective tax rate of the parent. And as a quick refresher from level 1, when we say effective tax rate, we are referring to the income tax expense divided by the pre-tax income. This part of the curriculum emphasizes this concept of transfer prices, and what is stated is that transfer prices refers to the pricing that a company establishes between its subsidiaries. So if the parent company is buying and selling from this subsidiary, the prices are referred to as transfer prices. Obviously, companies will try to establish transfer prices that minimize taxes. So if possible, the pricing will be set such that the tax exposure or the tax liability is in countries with lower tax rates. By doing so, a company can reduce its overall tax expense. However, countries obviously do not like this sort of strategy. So many countries establish laws and practices to prevent aggressive transfer pricing strategies. By aggressive in this context, we mean pricing strategies that try to minimize taxes. Also, whether and when a company pays income taxes in its home country depends on the specific tax regime. You might have a particular country where the tax rate is 40%. Companies based here might operate in other countries where the tax rate is 20%. So the tax regime of the home country might say that you pay 20% here in the foreign country, and then the balance is paid in the home country. This is one scenario. Later in corporate finance, we will talk about multiple tax regimes. At this point, you don't need to understand the specific tax regimes. Just recognize that different countries will have different tax regimes. From a testability perspective, you need to recognize that information about the impact of multinational operations on the effective tax can be obtained by studying the disclosures. And example 10 helps us do just that. We are given excerpts from the financial statements of two companies, Heineken, which is a Dutch company, and Colgate-Palmolive, which is a United States-based company. And for each company, we are asked about the statutory tax rate. This is the legal tax rate in the home country. We are asked about the impact of multinational operations, and then we are asked about changes in the tax rate and the impact of multinational operations. So let us look at these three questions for Heineken. Here are the financial statements. The first one has to do with the statutory tax rate. That is simply the domestic tax rate, which is 25%. What is the impact of multinational operations on the effective tax rate? We get that from this row. Note that the effect of tax rate in foreign jurisdictions was positive 1.9% in 2010 and then positive 3.5% in 2011. Positive in this case is bad because what this is saying is that the effective tax rate is going up. The company is now paying higher taxes. What does this suggest about the geographic mix of the 2011 profit? What this implies is that in 2011, the company expanded in countries where the tax rate is higher. So not explicitly stated here, but clearly the tax in the home country is relatively low. Possibly in 2011, Heineken expanded in the United States, which has a substantially higher tax rate, and so Heineken ended up paying a higher level of taxes. Here we have the numbers for Colgate-Palmolive. The statutory tax rate is 35%. And this column shows the impact of earnings taxed at other than the US tax rate. Notice that over the years, the impact has been negative. In other words, by operating in other countries, this particular company managed to reduce its effective tax rate. Section 5, additional disclosures on the effects of foreign currency. For multinational companies, sales growth is driven by changes in volume, prices, and exchange rates. As an analyst, you need to be able to figure out why the sales is increasing. So if we have a simple scenario where sales are increasing from 100 to 150, what we are saying here is that there are three possible reasons for this 50% increase. The first reason might be the increase in volume, so more goods are being sold. Another might have to do with increases in prices, and then in the context of multinational operations, a third reason might have to do with the change in exchange rates. If there is a favorable movement in exchange rates, then obviously that will increase the value of sales coming from multinational operations. Note that the sales numbers being reported are in the parent's presentation currency. You need to be able to decouple these effects or isolate each effect and recognize the fact that management has control, or relatively speaking, management has control over volume and prices. So increases in volume and prices are more sustainable relative to changes in the foreign exchange rate. So in a given year, if there is a favorable impact due to a better or higher FX rate, the increase in sales because of a higher foreign exchange rate is not sustainable. Management has no control over FX rates. You can go over example 11, which deals with some disclosures made by Procter & Gamble, a US-based company, and they define this metric called organic sales growth. Organic sales growth is not a term that you will see in IFRS or US GAAP, but effectively what Procter & Gamble is trying to do here is show the impact of variables such as volume and price and pulling out or removing the impact of changes in foreign currency rates. That is the main point. Again, if you have time, you can look at this. As an analyst, when you simply see a growth rate of say 20%, then you need to go through the disclosures and figure out how much of this might be explained by FX rates. As an extreme scenario, it might turn out that all this 20% increase is coming purely because of a higher foreign exchange rate, which means that the company cannot really claim any credit for this 20% increase. Also, in the disclosures, you will see that companies talk about exchange risk. And a good example is given related to BMW. BMW is based in Germany, so the presentation currency is the euro. BMW exports to various parts of the world, but the three major export markets for BMW are China, the United States, and the United Kingdom. So clearly the sales numbers reported by BMW will depend on these three exchange rates. What BMW does in its annual report or in its financial disclosures is provide a sensitivity analysis for each of these exchange rates. For example, if the dollar to euro exchange rate increases, then what is the impact on sales? Similarly, what is the impact on sales if this exchange rate changes? Or what is the impact on sales if the pound to euro exchange rate changes? That's called a sensitivity analysis and gives a sense for the riskiness associated with sales numbers, and specifically the riskiness that comes because of fluctuations in exchange rates. Now I will give you a quick summary of what we have covered in this reading. Very broadly speaking, I'd say that this reading has three parts. The first part deals with foreign currency transactions. Then the second, which is the major chunk, deals with translation. And then we have this final little chunk that deals with the impact of multinational operations on the tax rate and the impact of exchange rates on sales numbers. In terms of foreign currency transaction exposure, here we are saying that a given company buys and sells in a foreign currency. What then is the FX risk? And this is the simple table that you need to learn. Then we talk about translation. Here, a parent company has operations in other parts of the world and needs to translate the financial statement elements of the subsidiary into its own consolidated financial statements. The first critical point here is to understand that we have two methods, two translation methods. One is called the current rate method, the other is called the temporal method. If the foreign subsidiary's functional currency is not the same as the parent's presentation currency, then the current rate method needs to be used. Otherwise, the temporal method is used. You need to understand the impact on the financial statement elements of using these two methods. With the current rate method, all assets and liabilities are brought over at the current rate being the balance sheet date when the translation is happening. The revenue and expense numbers are brought over at the average rates for the year. Equity is brought over at historical rates. But then with the current rate method, the translation adjustment is shown in equity. It is not shown in the income statement. With the temporal method, monetary assets and liabilities are translated at the current rate. Non-monetary assets and liabilities are translated at the historical rate. The translation gain or loss is shown in the income statement. You need to understand the impact on ratios of using one method versus the other, and remember that the impact on ratios obviously depends on the method, and it also depends on the balance sheet exposure and the direction in which the currency moves. You need to understand the translation methods for hyperinflationary economies. Under US GAAP, we simply use the temporal method. Under IFRS, we need to restate for inflation and then use the current rate method. And then finally, part 3, when a company has multinational operations, then the tax rates of the subsidiaries obviously impacts the overall effective tax rate of the parent company. And also, when a company has operations in different parts of the world, then the ultimate sales number which is reported is impacted by exchange rates. However, the impact of exchange rates is not sustainable. If we go with the simple assumption that exchange rates are mean reverting, then clearly just because exchange rate has a positive impact in 1 year doesn't necessarily mean that exchange rate will have a positive impact in the next year. That is it for this reading. As always, I want you to go over the summary, go over the learning objectives, do the examples that I have emphasized, and then recognize that not all examples have been created equal. There are some examples that I say that you should go over if you have time. So do just that. If you don't have time, then you can maybe just skim over them. But the examples that I have talked about explicitly in this lecture, make sure that you go over those. Also, the examples that are being made available as separate videos, make sure you do those examples on your own first before you look at the videos. Do all the practice problems. These are absolutely essential. And if you have time, then also do practice questions from other sources. That is it.